And welcome to our regular Case of the Week segment. This week's case relates to a conduit IRA and a rollover. As a reminder, these are real life cases drawn from calls to our consultants on the resource desk from financial professionals all over the country. Today, our question is, must an individual establish a conduit IRA if rolling money over from a qualified plan? And the answer is no, it's not mandatory, but in some cases, it might make some sense. A recent call with a financial advisor from Florida is representative of a common inquiry related to qualified plan to IRA rollovers. The advisor asked, "My client wants to take an in-service distribution from his 401k and roll it into an IRA. He wants to know if he should roll it into a new separate IRA, sometimes known as a conduit IRA, or if it's okay to commingle the rollover with the assets in his existing IRA." While there is no law or regulation that requires an individual to segregate assets rolled over from a qualified plan to a separate conduit IRA that only holds those assets, there are some tax and creditor protection reasons why your client might want to consider a conduit IRA. Below are three examples. Number one, by establishing a conduit IRA, you retain the ability to roll the assets back to an employer-sponsored plan. If your client intends to roll over the IRA assets that originated in a qualified retirement plan to another qualified plan at a later date, he should be aware that some retirement plans will only accept rollovers that have been maintained in a conduit and not commingled with other assets. Plan language will dictate which assets from an IRA, if any, a plan will accept as a rollover. Secondly, the individual might wish to preserve certain tax benefits if they were born after before January 2nd, 1936. Individuals who were born before January 2nd, 1936, and who receive lump sum distributions from qualified plans may be able to elect special methods of figuring the tax on the distribution. First, the asset in the plan from active participation before 1974 may qualify for capital gains treatment subject to a 20% tax rate instead of the usual ordinary income rates. Second, such individuals may be able to use a 10-year tax option, sometimes called 10-year forward averaging, to figure the taxes on the ordinary income portion of their lump sum. This special option allows an individual to figure the tax on his or her lump sum distribution by applying the 1986 tax rates to 1/10 of the amount of the lump sum distribution, then multiplying the resulting tax by 10. This tax is payable for the year in which the person receives the lump sum distribution. Taxpayers who qualify for the capital gains or the 10-year forward averaging tax treatments who are contemplating a rollover must use a conduit IRA in order to preserve their ability to take advantage of these options should they later roll the assets back to a qualified plan. Number three, ensure creditor protection in bankruptcy is preserved. As a result of the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005, individuals can exempt certain qualifying assets from their estates for bankruptcy protection. Assets in a defined contribution plan, such as a 401k plan, or in a defined benefit plan, a 415, 457, or 501a plan, are protected from bankruptcy in their entirety with no limit. Even old KEO plans, that is, qualified plans for owner-only businesses, have unlimited protection in bankruptcy situations. Assets rolled over from one of the protected plans to an IRA retain the unlimited bankruptcy protection given to them while held in the plan. In contrast, contributory assets to a traditional or Roth IRA are protected from bankruptcy up to the 2020 limit of $1,362,800. When determining bankruptcy protection, it may be advantageous from the record-keeping standpoint for an individual to keep rollover assets from a retirement plan in a conduit IRA separate from assets in his or her contributory IRA. While not mandated by the IRS or Department of Labor, conduit IRAs may still play a helpful role for some individuals. Before contemplating a qualified plan to IRA rollover, it's prudent for participants to consult with their tax and legal advisors about whether or not they would benefit from using a conduit IRA. As a financial advisor who works with participants in plans, you can play a pivotal role in helping them with cases such as this. If you're looking for a more in-depth written version of this case, you can find it on our website at retirementlc.com.